This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Jonathan Crowder of Intelis Capital. Jonathan, thanks for joining us.
Thanks so much for having me. I really appreciate the opportunity.
Great. Well, so how did you get into early stage investing?
Yeah, so in order to answer that, I sort of have to go back to the beginning, really. I grew up in an entrepreneurial family. My father was a software entrepreneur. He was just crazy enough to start a software company when my mom was pregnant with me. A very bold move, and I always love to tell this story because I'm so proud of the work that he put in. He and his partner shared one computer between the two of them. So they had both been at Texas Instruments. And my father, because he had a pregnant wife, he was crazy, but he wasn't that crazy. He kept his day job at Texas Instruments. His partner left Texas Instruments, had the computer during the day, would code during the day, would bring this is before the era of laptops. So he would bring the desktop over to my parents' house at night. My father would come home and have dinner with my mom, and then would code through the night and go back to Texas Instruments in the morning. So I grew up around this entrepreneurial family. And so I was probably unlikely to ever be a great fit for a really traditional corporate job. So went to SMU in Dallas for undergrad. Dallas is home. And when I graduated, I did what a lot of people who are interested in startups do, is I went out to the Bay Area. And I actually wasn't working for a startup at the time. I was working for an energy policy think tank out there called the Breakthrough Institute, and spent just enough time in the Bay to really dip my toes into the culture out there, and realized I didn't really want to live in the Bay, and I didn't really want to work for an energy policy think tank, but I did love the spirit of entrepreneurship. And so I was very fortunate in that coming back to Dallas, coming back home, I got this incredible opportunity to work at a Kleiner Perkins-backed startup in the energy industry with a founder who was actually based in Plano, Texas. The founder, Jerry Dice, had started Choose Energy, I think in a story that's very similar to what a lot of startups have, that basically in his garage, it takes 10 years to be an overnight success. And so he had been kind of grinding away at it for 5 years and had managed to get the attention of some really tier one venture investors. I mean, I think, Kleiner is kind of as famous as it gets. And they had done the Series A. And so we had an engineering team in San Francisco and a digital marketing team in San Francisco, but the business operations were in Dallas. So I joined when it was, I would try to tell you the exact number of employees at the time, but I would almost certainly get it wrong, but let's call it 15 or 20 employees. We scaled the business. I think we got a little bit out over our skis at some points, and so we actually descaled the business, ended up transitioning from having an engineering team in San Francisco to ultimately changing it and actually building a new engineering team in Dallas, and had this really amazing roller coaster ride with a fairly incredible team that ultimately led to selling the business in June of last year. Having had this really profound learning experience of just getting a 360-degree view of the execution that goes into making a company like this work, and seeing the types of feedback that we got from the venture partners who were on our board, and just having really gotten this incredible learning experience, I wanted to think about what was the best next step and really how to give back. And I just kind of express that gratitude. And I realized that I think that my partner, Kevin, and I, who was also with me at Choose Energy, took this introspective look at, okay, well, what made things work at Choose Energy? And then wanted to find the highest leverage way to use that knowledge going forward. And I said, I think that that's actually really the genesis of why we're doing this.
So when did you form the Intelis Capital group?
Yeah, so we officially launched June of last year. We knew, I would say that when you work for a venture-backed startup, often things end in one of two ways. And in our case, I think it was clear that it would end in one of two ways. And basically that's things go really well and you need a new job, or things go really poorly and you need a new job. And so we knew that would be the narrative there at some point. And I think it was clear that we were shaping the company to be ready for an acquisition. We had done a fair amount of soul searching before the acquisition actually took place of, do I want to try to move to the Bay and be a senior associate at a large traditional firm, or is there an opportunity closer to home? And so we spent some time really just getting to know other entrepreneurs here locally in Dallas and also Austin and in Houston, and just in kind of true product manager fashion, I think getting to know the community and just saying, what's missing? What's your experience been like, to try to validate the hypothesis that great technology companies would be founded here. And when we saw really compelling signs of an opportunity here locally, we thought that, yeah, sure, we could do the thing that everyone else does and make the pilgrimage out west, or we could start our own firm and try to leverage the knowledge that that we had the opportunity to learn a lot closer to home.
Well, that sounds great. So with Intelis Capital, what are you guys now focused on? Who's a good fit for your group?
Yeah. So I think of that from a couple of different angles. So we're pretty thesis-driven investors. And so we wanted to take a step back and just sort of look at a couple of factors, which is one, where would our experience be most useful to help entrepreneurs and young companies? And then also just thinking about it from a very high level of what is the economy likely to do over the next 50 years? And so we took this approach of, okay, let's look at the major industries in the economy. And if you look at the last, say, 15, 20 years, a huge percentage of the price inflation in the economy, something like 80, 85%, is basically in one of three industries. So it's all healthcare, education, and real estate. So, and I would add that those industries and a subset of other really heavily regulated industries are also at or near historical lows for productivity growth. In some cases, it's negative productivity growth. So let's extrapolate that and fast forward 50 years. One of two things will almost certainly have to be the case. One is every American works in one of three industries. An economy can't function that way. So I'm pretty confident that that won't be the case. Or the alternative is technology will bring massive productivity growth to these industries. And so the question that a lot of people then ask is, okay, well, why isn't it happening? And it's, we believe, actually a very logical outcome that happens with a misallocation of resources. So if I wanted to create on-demand cupcake delivery startup, let's say, I would want someone, I would expect to find an entrepreneur who probably is actually well outside of the traditional transportation and logistics industries, because I want someone who is not burdened with the drag of orthodoxy. They don't do something because that's the way it's always been done. The trouble is that that's not really how innovation happens in hard, important, high trust, high regulation industries like healthcare, like energy. And so if I go to Texas Health Resources or Baylor Scott and White or Rice Medical Center or TMC, and I say, I'm a technologist and how you guys do technology is dumb, and so we're going to rip and replace everything that you have today, they would laugh me out of the room. And so what we've seen, and this was our experience at Choose Energy when we really found our groove, was the differentiating factor of companies that are successful in these industries is often more about a deep understanding of the incumbent customers and go to market, and less about bleeding edge technological solutions. Technology is, of course, important, but that's table stakes. And that the thing that really differentiates those who are successful is that they're often people who have been sort of tangent to these industries for a long time. So they really deeply understand the customer. And so we looked at, okay, well, where are the homes of some of these industries that are 30, 40, 50% of our GDP and rapidly growing that haven't been affected by technology? And the answer to that question is, in fact, those industries largely are not based out of Silicon Valley. And in many cases are not based out of New York, with the exception of finance. They're based out of Dallas and Houston and Nashville and Atlanta and the Research Triangle. And so I think what we've seen is just this dramatic misallocation of resources. Yes, Silicon Valley is an amazing place that has developed, I think of cities as organizations, and they've developed this incredible organizational competency at building a very specific kind of company, which is meaningful, but it's not the only kind of meaningful technology company that can be built. So we're looking to support entrepreneurs who are working on society's hardest challenges in these, what we believe are radically underserved ecosystems. So those are the industries. In terms of stage, We think that we're best suited when we're in the round. We prefer to be the first institutional capital partner. Broadly speaking, that ends up being either seed or Series A. And just in that our experience in terms of when we came in to choose, I think is most analogous to the experience that entrepreneurs go through when they're at that earliest stage where they're starting to do some significant hiring. Maybe they found product market fit. Very often they haven't. And just trying to deeply understand the problem statement. And so that's typically when we like to get involved. So it's regulated industries, Texas in the Southeast, seed and Series A. And that's the really long-winded way of explaining that.
So you mentioned underserved ecosystems and you're in Dallas. Where else are you focused on as far as geography goes?
Yeah, so we would think of ourselves as pan-Texas. So that's Dallas, Houston, Austin, San Antonio. We would certainly be interested in talking to entrepreneurs who are from other cities in Texas, but just from a density standpoint, that's where I would say we spend the most time physically on the ground. And then in particular, as I think I mentioned earlier, Nashville is of particular interest for both healthcare and finance, the Research Triangle, and Atlanta in particular. I suspect that there are other cities that will have really interesting pools of talent for some of these industries, but those are just the first places where we're finding ourselves spending a lot of time.
And so I assume it's tech-based, or do you also do healthcare and other application areas?
So I would say it's all tech-based. And I guess actually this is an interesting opportunity to sort of get on the soapbox for a minute. I think today every company is a technology company in some sense or another. Will certainly, or almost every company is a technology company. The Walmart is certainly a data company. Amazon is obviously a technology company, but 30 years ago we would have thought of what they do as just retail. And so I think every company is a technology company. But yeah, so we'll do healthcare. And for the most part, we'll be primarily interested in digital health, unless so we're unlikely to invest in, say, building and scaling rural ambulatory surgical centers or something of that nature. So it'll all be tech. It'll all be grounded in technology because I think that that's the area where our competency makes us the best partner for founders. And that's one of the ways that we prefer to look at things is I'm really hesitant for us to make an investment where we don't feel like we're the best possible partner for an entrepreneur. And I just think that aligns interests in a much stronger way. So that's how we tend to think about it. So yeah, technology businesses and across all of those industries.
And as you do deal flow in these cities, Dallas, Houston, Nashville, et cetera, what are you finding out there? Are you finding a lot of great deals? Or are you finding a lot of early deals? Or what's coming up on the radar that you like and what do you wish was more there?
Sure. So I have to say, we came in with a hypothesis about what we would see. And largely the deal flow that we have been getting, I feel like has validated that hypothesis. There's always some risk of getting a performativity bias. And so we try to be very transparent about the types of businesses that interest us. And so you never know if how much that influences your deal flow. But what I will say is that we get a tremendous amount of deal flow in digital health, especially from Texas, Dallas and Houston in particular. We see a tremendous amount of deal flow in terms of, and of course, medical devices. We see a tremendous amount of deal flow in the energy industry, in commercial real estate. I'm hesitant to say if that's everyone's experience or if that's because of our thesis and that we try to be really easy to engage with and understand what's likely to interest us and what won't. But I think that the early signs are really encouraging that these are areas of the country that are likely to create startups that create these types of businesses. And that's what we're seeing in the market. It's a lot of early deals. I think that there's a far less developed sophisticated angel ecosystem in some of the areas that we tend to invest in. I know that's an area that's near and dear to your heart, and I think is improving all the time. But that's something that Silicon Valley does really, really well. And so sometimes as a result, we end up seeing companies perhaps a little bit earlier in their life cycle than would be the case if they were in Silicon Valley, where they would likely have done an angel round or two. And figuring out how for us best to engage with those companies is something that I think is an ongoing question for us, because we want to be helpful to everyone, even though we can unfortunately only invest in a small percentage of the companies that we actually see.
Well, that's great. I agree. Angel groups can really help the ecosystem and mature the companies, fill the gaps, and help the companies get to the next stage. And we're all the time trying to close that gap that we have in Texas, but I think we are getting there. But in the last few minutes that we have of our interview today, what else should we cover?
I feel like kind of run the gamut there. I would say that an approach that we've taken and that I hope other investors take as well is that we have this internal value principle at Intelis Capital. And it's something that I think and that I hope has been a great service for the community and that I hope other investors feel the same way. And I think it's increasingly becoming the case is we have this value principle, which is every time that we meet with an entrepreneur, they should get some form of value. Now, it's just the nature of the beast that most of the time that value does not come in the form of a check. But great investors, I think one of the things that they can offer is that they should also be company builders. And so sometimes it's as simple as a piece of strategic advice or someone else who's working on the type of thing that you're working on and you two should know each other. Or it's let me introduce you to a customer, or it's I know an engineer who's a great fit for the position that you're trying to fill. But we try very hard to help everyone we meet in some small way. And I think that we talk a lot internally about this, and it's like I would like to believe that being nice shouldn't be a competitive advantage. and unfortunately, sometimes I think that it is. But I would love to see a more densely interconnected community that believes in giving first. I think that it's something that we've seen change in a positive way since we became sort of involved in the startup community as operators at Choose Energy, 5-6 years ago. And I think that that's something where we still have a long way to go. Because when I spend time in Silicon Valley, I will say that it seems like everybody has a best friend whose roommate one time was the VP of business development at Dropbox, and they're happy to tell you about how they thought about signing up small businesses. And that's something that we can do better as an investor community. And I think it's something that that the entrepreneurial community can find ways to do better locally as well. Because I think that that's one of the things that really helps build a vibrant innovation ecosystem.
Well, absolutely. You have to give first before you give something back. And ecosystems at the startup stage are certainly built with the support of the community. They don't spontaneously arise out of nothing. They have to be built, and there's nothing to pay people for it. So people have to give in order to create the basis for that. So applaud you for taking that position.
Yeah, sounds right. It takes a village.
That's right. So how best for the audience to get back in touch with you?
Absolutely. I mean, LinkedIn is always easy. My email is on the website, but it's jonathan.crowder@inteliscapital.com. I try to be really accessible. It's my intent to reply to everyone. If you haven't gotten a reply from me, email me again, because we're trying incredibly hard to be visible. I think it's our feeling that you should really always get to engage with the partner of a firm, and that should be your first point of contact as an entrepreneur. I just think that sends the best message. And so we try really hard to be easy to reach. So LinkedIn, email, Twitter @JMCrowd. If I'm online and you reach out to me that way, you should expect a response.
Well, that's great. Well, I appreciate you being available to the community. We'll put that in the show notes for people who want to get back in touch with you. And I want to thank you for taking time today and hope to have you back for a follow-up interview to see how things are going, and hope it goes well.
I really appreciate you giving me the opportunity to share a little bit of our story.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.